In this sim, we're going to cover several of the calculations that we've looked at for class and that you're going to see on the upcoming test. Before I start doing any of the calculations, I like to sit down and line out all of my information and go ahead and get it up on the spreadsheet. So what I'm going to do is I'm going to copy and paste this information and put it into a spreadsheet. And then I'm going to use that to go ahead and start setting things up. So in this problem, we have Lily's Luxury Liver Treats, and they're trying to decide whether or not to purchase a machine. It goes in and it says to help Liliana, the finance manager, determine the following information about the new machine given the following information. Okay, then it says, if purchased, the new machine will cost $20,000. So the cost of the machine is $20,000, and I'm going to put this in as a negative because that's going to be a cash outflow, and that's going to happen in year 0. So I've done a little bit of formatting here to make it look a little nicer. That happens in year 0, and now I've put my columns in for years 1 through 4. Then it says the new machine will result in $3,000 of maintenance cost each year. And I'm going to put those in as a negative, again, because they represent a cash outflow. Then it says the company would depreciate the machine straight line for 4 years, and the machine is expected to have no salvage value. So if it doesn't have any salvage value, we don't have to subtract anything from it. We can just take the cost of the machine and divide it over the 4 years. And since it's going to be a cash outflow, and since that's going to be a cost, we're going to show that as a negative here. So we don't need to flip the sign and divide it by 4. And we'll drag that number across. Okay. Then it says the company also has an option to lease the machine for $6,000 per year and would have no ownership rights in the machine at the end of the lease period. The company would not incur separate maintenance costs. These are included in the lease payments. So then the things I've been looking at here are the cost to purchase. So I'm going to actually make a label for this section. And then I'm going to drop down and do something similar for the lease. Okay, so I have everything in nice, neat sections. And it says that the company would lease the machine for $6,000 a year. Again, I'm going to show that as a cash outflow. And I'm going to then take a look and see what other information I have. It says annual cash revenues are expected to be $15,000 for the first year and then grow by 5% each year. That's going to be true whether I lease or buy the machine. So I'm going to put that information in both places. And that would be a cash inflow, so that's $15,000. And then it's going to grow by 5% each year, so it's going to be 105%. 100% of what it was plus another 5%. And if it's going to grow each year, I'll drag that formula across because each year should be 105% of what the previous year was. And we said that that revenue is going to happen whether we lease or buy the machine, so I'll put it in both spots. Then it says the life of the machine would be 4 years. We already have taken that into consideration in the depreciation. The company's tax rate is expected to be 30%. We'll hold on to that because we're going to need that in a few minutes. And it says the company prefers to have a payback period of 2 years and the company requires a minimum rate of return of 5%. Okay, so we'll make a note of that and come back to those things. Then we go back over to the problem, and we're going to see what it asks for. The first item asks for, what is the traditional non-discounted payback period in years? In order to get to the payback period, we have to know what the cash flows are. And this asks for it if we purchase the machine, because this is subsection 1. So if the company purchases the machine, what is the traditional payback period in years? Okay, so we're going to go up here to the purchase, and I'm going to just drop the lease information down. Before I can get to the actual cash flows, though, I need to calculate one more thing, and that is the tax. Because if I am undertaking a project that's going to generate additional net income, the government is going to want to tax me on that, and I've got to figure out how much is going out the door. Tax is based on accrual basis net income, so we need to figure out what our accrual basis income is going to be. So what I'm going to do is I'm going to take the cost and put it up here. We're going to take the revenue and subtract out the maintenance costs and the depreciation. And we'll apply the tax to this amount. Our problem said that tax was 30% of the net income. And before we spread that, that's going to be a cash outflow. So we're going to treat that like a negative number. Okay. Now what I'm going to do is I'm going to calculate the cash outflow by taking all of these same numbers and tweaking them. So we still have the revenue, we still have the maintenance costs, the depreciation is 5,000, but now I'm going to delete this depreciation because in the cash outflow part of it, depreciation is not a cash number. It goes away. And instead, we're going to replace it with the tax expense because that is a cash outflow. And when we net together the cash revenue minus the maintenance cost, which is a cash outflow, and the tax expense, which is a cash outflow, we have our cash flows for each year. So I'm going to insert a few extra lines here. This is what payback period will be based on. Now, we already know how to do the easy payback period. We learned that in your managerial accounting class. If you had even cash flows, you would just simply take your investment and divide it by the net annual cash inflows each year. And that would give you your payback period in years. But when you have a situation like this where you have uneven cash inflows from a project, you have to do a little bit more complex payback period. So the first thing that you're going to do is you're going to figure out the year. And you're going to figure out the annual cash flows, which we've already done. so I'm just going to simply copy and paste these. And then I'm going to keep a running total. So for the first year, it just equals the cash inflows from year one. Year two equals the cash inflows from year one plus year two. And then so on and so forth. You just keep adding the cash inflows to the list. Okay? And so then we have to figure out how long does this actually take to pay back? Well, our investment is $20,000, and by the time we get to year two, we have completely paid it back, then some. So we know that our break is at year one, right? Year one doesn't completely pay it back, year two more than pays it back. And so we know we're going to have year one plus part of another year. So to figure out how much of the next year is going to take to pay back, we're going to have to do a calculation. So we'll take the investment, and we know that's $20,000, or I can just pull it down from here, and I turned it into a positive number. And then we're going to subtract out the year before it pays back. So in this case, we're going to subtract out the amount from year one. So I'm going to pull that from the cumulative amount, and I'm going to calculate the difference. The difference is the remainder to be paid back. Okay? And so what we're going to do is we're going to take the remainder to be paid back and divide it by the cash inflows from the next year. And so in this case, it's year two. And that gives us the percent of the final year required for payback. So the 10,100 to be covered divided by the 10,425 that we're going to have flowing in that year, and then let's show the decimals there, is going to take 97% of the year for that to pay back, or for it to reach the payback amount. So it's year one plus 0.97 of year two. So our payback period is 1.97. Now that is the undiscounted payback period. So if we look at question 2, we'll answer that question very briefly, and then we'll go on to calculate the discounted payback period, which is question 3. Question 2 says, using the discounted payback period, should the company buy the new treat machine? And the answer is yes, because the company would like to have a payback period of 2 years or less. This was just under 2 years. The company's fine with it. But then when we do the discounted payback period, we would need to take into consideration the cash inflows or outflows and discount them based on the period of time. So I'm going to insert a couple more columns here. and we're going to apply the present value factors. And I'm just going to insert these rather than make you watch me type them. Okay. And all of these factors came from this chart. So you'll always be given present value tables if you have to do present value calculations. And so each period came back at a different rate, and we bring each one back using the present value of $1 at 5%. So I've taken those rates, put them in here, and then we're going to multiply them by the cash inflow for each of those years. And that gives us the discounted cash flows. So now we're going to go through the same process, but we're going to do it using the discounted cash flows. First, let me label this real quick. Okay, and then I'm going to copy and paste. Actually, I'm going to just insert cells. That way it'll move everything else below down a little bit. And I'm going to change this to discounted. Then I will come back up here and I'm going to grab the discounted cash flows and replace my annual cash flows with those. And the investment is 20,000. Okay, it should actually be doing all of these calculations for me, but I need to make a manual change. So using the undiscounted payback period, my break was between years 1 and years 2 because we hit the 20,000 mark by the end of year 2. We do not do that by the end of year 1. And so I'm going to take out my border there, and now we're hitting that mark between years 2 and 3. So it's not year 1 plus, it's year 2 plus. Okay, so I'm going to do the same process. I look at my investment and I find the last year before the investment has paid back. So I go to the cumulative total in the year before payback. This time it's year 2, 18,884. And I subtract that from the investment. That gives me the remainder to be paid back in that next year. This time it's 1,116. From there, I'm going to divide that by the cash inflow from the final year of payback. And this time it's from year 3, $9,482. And it tells us that the percent of the final year required for payback is 12%. So the payback period here is going to be 2 years because that's where we determined the break was, plus the 0.12 from the third year. So it takes 2.12 years for it to pay back if we're using the discounted cash flows. When we go back to the problem and we look at the questions, what is the discounted payback period in years? 2.12 years. Using the discounted payback period, does this investment meet the company's investment criteria? No, it's over 2 years. Then we look at problem 5. It wants to know what is the net present value of the cash flows if the company purchases the machine. When we look back at what we have it almost completely done. We know what the discounted cash flows are for years 1 through 4, but the net present value takes into consideration all of the cash inflows and outflows, and we are missing one. We're missing the cost of the machine itself. So I'm going to come down here and make another line for the net present value. And I'm going to bring down that negative 20,000 because it represents an outflow of cash when we buy the machine, and we're buying it at the very beginning of the project, so it's already in present value. And then I'll bring down all of the cash flows that we just calculated. And we're going to sum all of the cash flows now. The net present value of buying the machine is $17,872. And when we go back to question 6, it wants to know, using the net present value method, does the investment meet the company's investment criteria? Yes, it does. Remember, net present value, if it's 0 exactly, it means that it exactly meets the company's criteria because you've taken the investment potential of their required rate of return out of it and compared present value to present value. And so if it's 0 or greater, the company is going to invest in it. In this case, it's greater than 0 for net present value. The company would invest. It does meet the criteria. Then we flip back over and we answer the question, what is the profitability index? The profitability index is really simple. It is just your net present value divided by your original investment. So we're going to come over here and we'll just come up here a little bit. I'm going to take my net present value and divide it by my investment. I need to make my investment positive so that I'm working with positive numbers and I don't get something funky. And then of course I need to take, I took it way out there. Taking it out to the nearest hundredth, it's 0.89. Then the next question wants to know, what is the internal rate of return? The internal rate of return is going to be that formula that we learned earlier. So I'm just going to create a space for it. And we really only need one cell to do that calculation. I'm going to choose IRR. And then we're going to look at all of our cash flows to do the IRR, which means we need to pull, this 20,000. Oh, good grief. We need to pull this 20,000 up here because it needs to look at all of your cash inflows and outflows. So we're going to hit equals IRR, open parentheses, and then we grab all of the undiscounted cash flows. Because remember, what IRR tells us is it tells us what is the percentage that the company is actually going to earn on a discounted basis. Or another way to look at that is, what percentage rate of return would the company use to make the net present value equal exactly 0, right? So what is the real discounted rate of return the company is earning given these cash flows? So you use the undiscounted amounts so the formula can do its magic and get you the right percent. Okay, so IRR and then all of the cash flows in order. Hit enter. And the internal rate of return on this is actually 38%. So if the company used 38% and brought everything back to present value using that as its percentage when it's determining its present value factor, the net present value would have equaled exactly 0. Then question 9 asks, what is the annual tax shield of related expenses? This one is a standalone question. It doesn't go back and affect any of these other calculations that we've done. It just wants you to take the information that you already know and calculate an amount. Remember, the tax shield is how much tax the company saves due to having expenses recorded on its books. And so the tax shield associated with this investment would be the tax rate minus the expenses taken into consideration for net income. In this case, maintenance costs and depreciation. So I'm just going to copy these and come down here and insert them. And I'm going to add And really, I only need to do that calculation once because I believe it asks for the annual tax shield. Yeah. What is the annual tax shield? And the expenses don't vary, so the annual tax shield is going to remain the same. So we have $8,000. The tax rate is 30%. And so the tax shield is going to be, I'm going to make this positive, so I'm going to flip the sign on that, times my tax rate of 30%. My tax shield is $2,400. And that's going to be the same every year. So every year the company saves $2,400 in tax due to the expenses that it deducts. I'm going to add a label to that just so we know if we want to go back and look at this sheet. Okay. Oh, except I can't spell. I can spell, I just can't type. Okay, that's what we have there. Okay, so now we're ready for subsection 2. And it wants to know if the company leases the machine, what are the answers to these following questions? The next question asks, what is the annual tax shield generated by the expenses related to the lease? So coming back over here, we've just calculated the tax shield related to purchasing the machine. If we wanted to lease the machine, I'm going to flip over here and add a new tab. I'm going to go ahead and copy these things though. And when I go back and take a look at the information, that's going to help me figure out what expenses I have. So all of these relate to purchasing the machine. This relates to leasing the machine. If the company also has the option to lease the machine for $6,000 per year and would have no ownership rights in the machine. So that means that it's an operating lease. If a company leases something and doesn't own it, then it's an operating lease and you can deduct the full value of the operating lease payments. If the company ends up having ownership rights in it at the end, it means that it's a financing lease and you treat it like it's a rent-to-own situation, in which case the full value of the lease payments could not be deducted and the company could only deduct depreciation. But in this case, it is an operating lease. We get to deduct the full value of the lease payments, which are $6,000. Then it says the company would not incur separate maintenance costs. These are included in the lease payments. It also comes down here and tells us that we have annual cash revenues of $15,000. We already know that, and that's not related to the question that we're being asked right now. The question we are being asked right now is, what is the annual tax shield generated by expenses related to the lease? So when we purchased the machine, the expenses we had were maintenance costs and depreciation. We don't have either one of those for an operating lease because the problem tells us that the company that's leasing the machine to us will take care of the maintenance, and we know that we don't have depreciation because we don't have any ownership rights in the machine. So the only expense we have going out the door that would generate any kind of a tax shield for us would be the lease payments themselves. We're going to put those in as negative $6,000 because it represents an outflow of cash. And those are annual, so I'm going to spread those across here. Since this is the only expense I have, I can just take the tax rate and multiply that by my lease payments, and that gives me my tax shield. And I really only need to do this once, just like before, because it's the same every year. And I'm going to flip the sign on my lease payments, multiply it by my tax rate. My tax shield is $1,800 each year because that's how much deducting those lease payments saves me in taxes. Then I look at question number 11. It wants to know, what is the net present value of the investment if the company leases the machine? So if the company leases the machine, we have to take into consideration all of the cash inflows and outflows to get to the net present value. So we would have the revenues from the machine. And actually, instead of doing that whole calculation again, I can go over here and just copy and paste. Because remember, we have revenues of $15,000 in the first year, and it goes up by 5% every year. And then we have the cash outflows, which would be the lease payments. And I'm just going to pull those straight down. Then we're going to have tax that we have to pay on the net income that we have as a result of the machine. Well, we have to backtrack and do the same thing we did when we calculated the information for the purchase. The first thing that we needed to do was we needed to calculate the net income and figure out what the tax expense was, and then go through and do a separate listing for cash expenses and cash revenues. So we're going to do the same thing here. This is going to be the net income. Calculation. And it will just be the revenue minus the lease payments. Tells us our net income each year. Then our tax rate is 30%. And our tax due on that net income will be the net operating income times the tax rate. And we had to do all of that to get to the tax that we were going to pay in cash. And now we come down here and we take a look at the cash flows. So we have revenue minus our lease payments. But we are also now going to have income tax expense. And I'm going to pull that amount down and make it negative because it represents a cash outflow. I'm going to pull my numbers across and I'm going to change my title here. These are the cash flows from each of those years. Okay, so I have revenue minus the lease payments minus the income tax expense that comes from the actual investment itself. So looking back at the problem, it asks, what is the net present value of the investment if the company leases the machine? And so I have all of my cash flows. I don't have another number to bring down here like I did when I did the purchase. And the reason for that is that I don't buy the machine. In the purchase scenario, I purchased the machine for $20,000 up front in year 0. When I'm leasing, I don't have that. I'm just making lease payments each year. And so these represent the cash flows. Then I just need to multiply them by my present value factor to get my discounted cash flows. And so I can copy and paste that because it will bring my factor over here. And it should also bring my formula multiplying C18 times C19. So these are my discounted cash flows, and my total will just be these added together. $25,107. Then number 12, should the company lease or purchase the machine? I'm going to make that decision based on my net present value. And so net present value for leasing is $25,107. Net present value for buying is $17,872. Looks like I should lease the machine in this case. This is the end of this problem. If you have any questions, please let me know.